it's very important to know that legally, when you put money in a bank, it's no longer your money. You just lend that to the bank. And this came, of course, after the last crisis in 2008, 2009, through a ton of legislation that was passed through. So when you put money in a bank, it's no longer your money. The bank owes you that. You lend it to them. The second thing is it's also not there. The money's not in the bank because of the fractional banking kind of model that we're in. And if you go and try to get your money out of the bank, also, they don't have to give it to you. So folks should definitely be aware of this, because this is a danger for business owners and investors.
Without further ado, MC, I want to ask you a couple quick questions here. So we're talking about a looming financial crisis, the biggest in the last 80 to 100 years. So I'm going to rattle off four that kind of come to mind when I'm thinking about financial crises. And one would be the U.S. savings and loan crisis in the 80s. Two would be the junk bond crisis again in the 80s. Three would be, a combination of the Mexican peso and the Asian currency crisis in the 90s. And then, of course, we can't forget about everyone's all-time favorite, 2008 global financial crisis. Why could this possibly be worse than any of those?
Yeah, and those were all rough, right? Those were all rough crises. Here's what a lot of folks probably haven't gotten in the information on, because it hasn't really been published out there by the media. So when the first three banks went under this year, and so we had Silicon Valley Bank, we had Signature, we had Silvergate Bank, and these are also three very crypto-heavy banks, right? So when they went under, their depositors were made whole, because there was obviously a lot of very politically connected people that were banking with Silicon Valley Bank. So their depositors were made whole on the accounts that wasn't insured. And a program, over the weekend was kind of rolled out just by the Federal Reserve, the U.S. government, the U.S. Treasury, and so forth, to make all these depositors whole. And they called this not a bailout, we're no longer allowed to use that, but a backstop. And essentially, Jamie Dimon from JP Morgan Chase came out once he started to realize what was going on here, and he said, wow, it looks like this program hasn't even really kicked off, and this is probably going to run about 2.3 trillion with a T, $trillion, $2.3 trillion. Now, let me put that into perspective. During the great financial crisis, the GFC, as it's now known, in 2008 and 2009, Hank Paulson, who was the Secretary of the Treasury, had to basically go and beg Congress, because he still had to at that point, for $700 billion, a bailout of $700 billion. So if you just do quick math, you'll already see that it's already 3 times the size of that, just with 3 banks going down and other banks then looming. And of course, as time progressed, we saw First Republic go under, and now there's a ton of other banks under stress. So just initially, the backstop, because it's no longer, we're no longer allowed to call it bailouts. The backstop is already more than 3 times the size of the great financial crisis, the GFC in 2008, 2009. And then something I think that really shocked a lot of folks was that Janet Yellen went up to Capitol Hill. She was questioned in some committee hearing. And there was a senator from Oklahoma, I believe it was a senator from Oklahoma that questioned her about, the banks in Oklahoma, saying, look, we have small banks, we have regional banks here. What would happen to those depositors if some of these banks go under and they weren't in accounts that were insured by the FDIC? Would they be made whole? And she said, well, no, they're not insured. And then you could see he was kind of rattled. And he said, well, wait a second. So you're telling me that these depositors that have deposits in account that's not insured will not be made whole like the account holders at Silicon Valley Bank? And she said, well, again, kind of in the her own way, that no, well, they're not insured. And he said, well, do you understand that all these smaller banks and regional banks, the depositors will flee these banks to go to the bigger banks, all these too big to fail banks, because they'll feel that their capital would be safer in a bank? Because Janet Yellen also said, well, myself, along with the president and the Federal Reserve and the FDIC, we will look and see whether a bank poses a systemic risk to the entire system or not, and then we'll make a decision to bail out banks, backstop, sorry, I caught myself there, to backstop banks or not. Well, and then the senator looked at her and said, well, you know, the capital's just going to move to the too big to fails. So she said, well, we certainly wouldn't want that. And this clip is available for everybody to see on YouTube.
We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're
it's-
fully insured no matter what the amount is. If you're in a big bank, you're not fully insured if you're in a community bank.
Well, you're not fully insured.
Yeah, that is exactly what ended happening. And that's why if you look at what's currently happening is all the smaller banks and regional banks are struggling in the process of collapsing, and they're all being eaten up by bigger banks because the capital flight is something like we haven't seen. Now, there's currently around about 4,800 banking licenses in the United States, which the majority of them are your smaller and regional banks. Now, if all of these smaller and regional banks go under, I mean, you're going to see something like you haven't seen in 80 and 100 years as far as a banking crisis, which will then lead into a financial crisis because it's all connected, right? It's like George Costanza said, it's all pipes, it's all connected on Seinfeld. You know, the smaller and regional banks are the lenders to small businesses and real estate investors buying properties. So there's a ton of industry that's going to be hit by this. So that's why it's setting up that this could be one of the biggest crises as this is developing. Now, this isn't something that's going to happen overnight. This could be a while because we're now in a process of consolidation where you see a lot of these smaller banks and these regional banks are going to be just eaten up by the big too big to fail banks, like with First Republic being eaten up by JP Morgan Chase, right? It looks like they're the designated vacuum cleaner in this crisis, as Bank of America was the designated vacuum cleaner in 2008, 2009.
All signs are pointing to the consolidation, of course. So, you know, people aren't trusting the banks as much, so deposits are down. So what are the banks doing to try and get more deposits? And they're having to tempt people with better rates. So it's more expensive for them to acquire those same deposits. So, you know, to your point, it's all going towards that consolidation. And, you know, just over the history of time, you kind of see the hallmarks of this happening, and it always ends up in the same thing. So when there are these banking crises, it always ends up in bank consolidation. So you're just reading the tea leaves. We've seen this movie before, correct?
Yep. Yeah, I'm just looking at the past, what's happened, and you know, a ton of those crises that you've mentioned. The big one in 1929. I mean, there was, I think, approximately over 12,000 banks at that stage in the United States. Look where we are now. You know, 4,800 banking licenses. So there's a huge consolidation since then. So I think that's absolutely what we're looking at right now. And then, you know, the other thing that folks should be aware of, and this is very important, the legal frameworks have been put in place, which a lot of people are not familiar with, or nor that they pay attention to it, that allow bail-ins. And of course, there was leaked footage of the FDIC. This is also available on YouTube, where you can type that in, of members of the FDIC talking about that there most likely will be bail-ins, right? And so why am I sharing this? It's very important to know that legally, when you put money in a bank, it's no longer your money. You just lend that to the bank. And this came, of course, after the last crisis in 2008, 2009, through a ton of legislation that was passed through. So when you put money in a bank, It's no longer your money. The bank owes you that. You lend it to them. The second thing is it's also not there. The money's not in the bank because of the fractional banking kind of model that we're in. And if you go and try to get your money out of the bank, also, you know, they don't have to give it to you. These are very, very important things to know legally, because we've already seen this in other parts of the world. So it's also not, you know, MC coming on with a tinfoil hat or a tinfoil sombrero and saying this could happen in the future. It literally happened in Cyprus, and it's happened in other parts of the country, world rather, since then. So there's legal frameworks established all over the world for this. So folks should definitely be aware of this, because this is a danger for business owners and investors.
Yeah, by the way, I think you look phenomenal in that. Say a silver sombrero. Yeah, I'd like to see that. So assuming this all does happen, obviously the bank consolidation we're seeing it underway right now. So in your opinion, how does this affect, you know, the economy? How does it affect business owners? How does it affect real estate?
Yeah, I think that people are going to see a lot of disruption in there, which leads to a lot of fear and uncertainty. And you're essentially going to see, you know, runs on banks. And again, we saw, like in the Great Depression, you know, we've seen videos of runs on banks and people going to the bank demanding money. It doesn't happen like that anymore. It's all just being done digitally. So that's essentially what happened with Silicon Valley Bank. It was a digital run on the bank by their largest depositors. So it's going to happen digitally, which is going to lead to more banks failing. So you have to be diversified, because you do need operating capital in a bank. You know, you absolutely do as a business owner investor. So you have to be cognizant of where you bank, and also be diverse and diversify across different banks, right? So that if there is a shock to one bank that you didn't see coming, like there's a lot of folks in my network that were banking with First Republic, and some of them had all of their eggs in one basket. Well, if they had their deposits over a number of banks, they would have been a little bit more well diversified, because you do need obviously money and operating capital in a bank. How would this affect the economy? Well, a banking crisis, which, you know, we're in this debt-based monetary system, we're going to see significant stress on the debt markets, continue to see it. And then also how this plays into the average day for a business owner and an investor is you see liquidity dry up. So you're not going to be dependent on just going into a bank and getting loans, because like I said, smaller and regional banks, they're the biggest lenders to business owners and to real estate folks, right? So liquidity is going to dry up. So what we are doing is saying, we are looking at what's happening. We're seeing how this is unfolding, and this is dominoes kind of falling on top of each other. So we're being proactive, and we're positioning capital, and we're diversifying operating capital in banks to protect ourselves. So eventually you want to be in a position where you have access to liquidity when liquidity dries up, because then if you're the person with liquidity in a very liquidity scarce environment, you're going to be able to capitalize on opportunities.
Yeah, so let's talk about that. So at the top of the video, one of the things that we brought you on here, and we'll go ahead and drop some of that playlist, has been the whole life insurance policy and the infinite banking concept. And you're as good as I've seen with that, and I've talked to a lot of folks about that concept. Can you touch on that right now, and why that's more critical than ever to utilize, you know, vehicles like that to protect against, you know, times like this, but also to utilize that as an investment vehicle to snatch up these discounted assets that we're going to be finding right now?
Yeah, the first thing is, so for new viewers, so the infinite banking concept strategy is when you use a dividend-paying whole life insurance policy with a mutual insurance company, structured very specifically for cash value. So for the savings element in the policy, not just the life insurance, and it's essentially a vehicle where you warehouse capital. And now, why would you warehouse capital in one of these vehicles? Well, it's outside of the banking system and the Wall Street casino. Mutual insurance companies have been around since the mid-1800s. They've been extremely profitable every single year. since the mid 1800s. There's one of our carriers that we structure these policies with. I mean, we're talking like 1847, and they every single year they've paid dividends, which means they've been profitable. That's prior to the Civil War. If you
Just to be clear, every single year.
Every single year
they paid out dividends.
Yes, and if you look at if you want to stress test, let's just say those companies and the vehicle where you warehouse this capital, think about wars, whether it be the Civil War at the time in the United States. Most people don't know this, but you had two types of currencies moving around, right? You had greenbacks and graybacks, and during a time of such uncertainty, literally a civil war, these companies were profitable. Then you had world wars, two of them. You had the Federal Reserve was only created in 1913. Most people don't know this too. They just take it as it's always just been there, right? That was created. Then you had global monetary changes. In 1944, Bretton Woods was established. You've had recessions, the Great Depression. You've had the crisis in the 1970s with President Nixon closing the gold window on the world in order to they no longer allowed it the convertibility of dollars into gold, and then the petrodollar was established. So they've gone through all of these many different crazy scenarios, and they've been very, very profitable. So very important. Counterparty risk is huge, and I've mentioned counterparty risk consistently for the last 3 years. It's going to be one of the biggest risks that investors face out there. So that's why you put it in there. It's with a mutual insurance company. The vehicle has your capital guaranteed. It's guaranteed to grow tax-free. You get dividends, which is not guaranteed. But like I just shared, they've paid them consecutively every single year since the mid 1800s, which the dividends are also tax-free. You get tax-free access to your capital and guaranteed access. This is also huge because if you remember what happened to HELOCs in 2008 and 2009, a lot of folks realized that they're not guaranteed. So you have guaranteed access to capital. And then, of course, it has a death benefit because it is a life insurance product, which then goes tax-free to your beneficiaries and so forth. The beauty with this vehicle, when it's structured correctly, is you can set up a life insurance line of credit. And there's many different ways to do this, but you could set up a life insurance line of credit using the cash value. So what this means is you never draw down your account value in there. You have a line of credit which you have guaranteed access through the insurance carrier to this line of credit, which you then can use the capital to then capitalize on opportunities. So why I think this is so powerful and it fits in so well during uncertain times is it provides that certainty that your capital is out of the banking system. It's also out of financial markets, so it's not tied to the stock market. So the first thing is protect that capital from the storm, and then put it in there so that you have guaranteed access to it so that you can use it to then capitalize on opportunities. Because there's many steps so that most people will not protect their capital properly. So they're going to lose their capital or not have access to it. And the second thing is they won't have access to that capital, even if it survives, and to then capitalize on opportunities. So you want to have it in a place that will weather the storm, and then where you have guaranteed access to then go buy assets at a discount. I will say this, here's a little fun fact that I saw this last year in November and December, and there was a lot going on. I think you and I also shared this in a previous conversation. Remember how the Vatican recalled all of their liquidity out of the financial system back to the Vatican Bank. And we at that time said, wow, what's going on here? Well, now we know with the banks going under that there definitely was something coming. But what I also saw was a lot of wealthy individuals and families set up these policies, like in family offices. They had a massive year doing that because, the insiders know this is a place where the capital can survive, which can then be leveraged and used to go and acquire assets at a discount. So in times of uncertainty, you want to position yourself where there are certain things that provide an element of certainty in your overall strategy.
Yeah, absolutely. So the writing's been on the wall for this for a while, guys. And to MC's point, we've done videos on this. I mean, a year ago, talking about exactly this ultimately happening, and it's happening right now. So, guys, we brought MC on at a very critical time right now. So, if you do have cash, if you're terrified of the banks right now, if you want to warehouse your cash in a very safe place, and then ultimately have that also as an investment vehicle to capitalize on distressed and discounted assets that are certainly going to be coming about right now. Reach out to he and his team and see if it's a good fit. Get some more information from them. You can email ninja@vipfinancialeducation.com. We'll drop that link below. Be sure to include your first, your last name, the best phone number to reach you, and VIP conversation in the subject line, and someone from he and his team will get back to you right away. There could not be a more relevant time to be talking about whole life and obviously the IBC. So thanks for diving into the IBC for us on these whole life insurance policies. One of the questions that I often hear, and you probably get that a lot if you don't mind explaining, is about the death benefit that comes along with these. So there is a built-in death benefit that the insured takes advantage of while they're alive still. Can you explain, how that works, and then when they can start taking advantage of that?
Yeah. So most people, when they think of life insurance, they think somebody has to die in order for someone else to benefit from that, right? Well, how these policies are structured is it's structured, as I mentioned, with a dividend-paying whole life insurance policy with a mutual insurance company that has that death benefit. So it has the death benefit feature, but there's also cash value because it's structured, as a supercharged savings account. So you have a death benefit usually of a multiple of your account value. So if something should happen to you, your beneficiaries, whether it's your spouse, your children, or a trust, will get a multiple of your cash value that's in that account. You compare that with a 401k and an IRA, and I've heard a lot of folks have self-directed, IRAs and so forth. If something should happen to you, then your beneficiaries will get the value of that account minus the taxes out, right? Where in this case, you not only get the full value of the account, but you get a multiple of that out in your death benefit, tax-free to your beneficiaries, whether it be your spouse, your children, or a trust. So it's a very, very powerful element to this. And we talk a lot through the infinite banking concept strategy about the supercharged savings account of that, and obviously having your money doing two things at once. But it's pretty powerful to have that in place. And if you get to especially your later stages in your life, right, pretty close to retirement, there might be people, they're no fault of their own, that come to a crossroads. Well, do I spend what I've accumulated during my lifetime on retirement, or do I leave some for my children? Having something in this vehicle allows you to do both. It's sort of a permission slip that you have, that death benefit, because you can tap into the cash value, and through the strategies that we teach, you could take out a tax-free income stream from retirement. And eventually when you pass away, the death benefit, obviously minus the amount that you've taken out while you were alive, then still gets paid out tax-free to your beneficiaries. So it's a very, very powerful strategy. Here's the central theme about it, and this is why I love it so much and I'm so passionate about it, is in life, in general, even outside of life insurance, I like choices and I like options. So if I have one thing that provides a ton of options and a ton of different opportunities that I could do with it, then I love it. And that's the big thing, because a lot of folks think, do I have to do life insurance? Do I have to save and protect my capital now, or do I deploy it? Well, you can do both. You can save and protect it and deploy it when it's needed. And of course, through the later stages, you don't have to choose about whether I draw from my accumulated savings in my life or whether I leave it for my children. You can have your cake and eat it too.
At what point could you start taking a loan against that benefit?
So you take the loan against the cash value. So you have the cash value, the savings element, and you can establish a credit line against that 30 days after you funded the account. So that's very important for folks too. Once you set up the policy, the process usually takes about 2.5 weeks. It's all, based on your personal situation. But 2.5 weeks, you have your policy set up, you fund it. 30 days later, you'll be able to set up that line of credit and, access liquidity to go and use and capitalize on opportunities.
So you're saying within a 30 to 45 day window, if someone were to, their total intent was to utilize this as an investment vehicle, that's how quickly they can get going.
Yes. And another question that folks always also ask is, what can they use it for? Well, you can use this as an emergency account. When you have 6 months of just lifestyle savings and household savings in these policies, you can reduce costs in a lot of different areas and raise your deductibles on other insurances, right? By doing so. But yeah, you can have it as an emergency savings account. You can tap into it for medical emergencies. You can use it to pay off debt. You can use it to invest in your business, purchase real estate, use it as a down payment, or pay cash for it. You're in full control. You're literally your own banker.
Because of that, there's no types of seasoning guidelines like there would be, borrowing from a bank with their underwriting guidelines and things of that nature. All of those are eliminated with this vehicle.
Well, yeah, 30 days after the policy's been
After the
funded.
30 days.
Yeah, and that's the thing too. The life insurance carrier has your cash value and your death benefit for collateral. So they are protected twice on that side too, and you're on this side where you get to warehouse your savings in a mutual insurance company that's been around since the mid 1800s with guaranteed growth, access to dividends that's not guaranteed, and that death benefit that's very, very valuable for just overall contingency planning, whether it be on your family or business or your investments.
Got it. So guys, again, if you want more information from MC and his team about the infinite banking concept and whole life insurance, go ahead and email ninja@vipfinancialeducation.com. Include your first or last name, the best number to reach you, and VIP conversation in the subject line. Someone from he and his team will get back with you ASAP. So thanks for joining us on today's video, guys. Take care. Make it a great day.